Hey everyone, welcome to the KE Report, a daily editorial on Thursday, October 2nd, chatting with Brien Lundin. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference this year, November 2nd to 5th. Shad and I will both be attending again this year, and hopefully we will see a number of all of you, our listeners, at that conference as well. Brien, let's focus in this interview more on the underlying precious metals equities. We've been talking a whole lot about just how much these stocks have run and where some of the opportunities still might be outside of precious metals stocks. But let's stick to the precious metals stocks here, starting with some of these, I'll call them optionality plays, more of these companies that have large resource bases. You have been on the show a number of times, especially over summer and even before summer, earlier this year, saying that you saw these as being very undervalued compared to just how much the gold price has run up. Over summer, as the gold price moves sideways, I saw a lot of these stocks re-rate. Ounces in the ground, sometimes valued for about $10 an ounce, are now worth $30 to $40 an ounce. These stocks have moved up two, three times just over summer. So my big question is, do you still see an opportunity in these optionality plays after pretty much all of them have re-rated higher?
Yeah, thank you, Corey. I really do. And you're absolutely correct. They've made big moves, so that was, a good call at the time. And we still call these optionality plays, but there's no more optionality left except for the re-rating. All of these plays, every optionality play, every out of the money resource that we followed for years as leverage on a rising gold price, every one of those is economic and robustly economic at these gold prices. So that's all gone. Now it's just up to the market to re-rate them, and it's in the process of doing that. So yes, I think it's still an opportunity. I don't think it's as much of an opportunity as it was, obviously, 3 or 4 months ago. But we need to remember that these kinds of deposits have typically, in a normal market, sold for $100, $150 an ounce or more. And that, again, is in a normal market situation. That's not in the kind of, rollicking bull market that we are now in terms of metals prices, but not yet in terms of M&A. So I think that's the next step. I think these kinds of companies still offer a tremendous amount of upside opportunity. But broadly speaking, I think the metals and the miners, as you say, have come so far that I think we're kind of entering a sideways period now. Is savvy, once, twice, many times burned investors in the sector are going to start taking some of these rich profits.
Well, Brian, I think you raised such an interesting point with what you just outlined there as far as how the ounces in the ground, even after being re-rated, sure, they're up to 30, 40, 50, but in prior cycles, when gold was in the 1800 to 1900 range back in 2011, these things were taken out for 100, 200, even $300 an ounce in the ground. We're not even in that environment anymore. We're at $3,800, $3,900 gold, and the margins that gold producers are making right now are $1,500 to $2,000, just the margins per ounce. So isn't it kind of insane that some of these development projects that they could acquire in an M&A deal are only being valued at 30, 40, $50 an ounce? Even $100 an ounce would be very low. So talk about upside. I mean, don't we aren't we going to get to the point where analysts come into the sector because they've ignored it for a decade? They come back in and say, holy cow, what you're actually valuing these development stage companies at is criminally insane. It's too tiny compared to what they're actually worth. A lot of their MPVs are in the billions or multiple billions if you use spot prices. So could we see that gap continue to close between where the ounces in the ground are valued now, where they've been valued in other sectors? And could we maybe even see valuations we've never seen before in the M&A once it really gets heated up?
Yeah, a lot to talk about there. Perhaps the most reliable aspect of these markets to bet on is human nature. And, the big majors, the gold producers were so burned and insulted at being regarded as spending like drunken sailors in past cycles that they really tightened up their act, preserved shareholder value, and in many areas and cases were very careful about M&A. We know that with human nature being what it is, it's going to revert to them spending like drunken sailors once again at some point. And in fact, with the shakeup we're seeing at the two world's largest gold producers over recent days, that may be what we're starting to see, and that they were not as freewheeling as perhaps boards and investors wanted them to be in terms of going out and doing some M&A and growing and advancing. So yeah, I think that's going to happen eventually. I think another aspect of that is what we're seeing in terms of generalist and or tech money looking at the sector and having big checkbooks and writing big checks, like what we saw with Tether's investment in the EMX Elemental merger. So I think that's the camel's nose under the tent in that regard, as far as generous money coming into the sector. And they have the ability to write checks that would be astounding to us historically in this sector. And we're seeing a lot of money coming into financings. I mean, $100 million seems to be the new $10 million financing these days, when for a lot of these companies over just the last week, the scope of the financings we've seen announced has been mind-boggling. So yeah, money's coming in, and it's not from the traditional sectors or inside the sector as we're used to.
Oh, so true, Brian. Just even last week, as you said, I saw over $200 million being announced and raised in junior companies that a lot didn't even have a warrant attached to it. It's a completely different financing environment. Honestly, one of the best financing environments I've ever seen, at least over the last 15 years in this sector. That being said, all these companies are cashed up now, almost across the board. Let's move down to the exploration plays, because more people are talking about exploration plays. There are so many drills turning and so many meters being drilled right now. And quite frankly, there's been some really good results out there. I've been noticing that 100-gram meter holes, those are coming almost in a daily occurrence from these companies, and some much, much higher. So really wondering what you're watching out there in terms of the exploration plays that are drilling a lot right now. What are you excited about?
Yeah, Corey, I've noticed the same thing and have been remarking on it, I guess, since the spring, that it's really amazing how good of results that we're seeing. Better than, on average, better than what we've seen for many, many years. And I think that may have something to do with the fact that companies were cash strapped for so long that all they could do was the inexpensive work, which is also the boring and necessary work of, geological mapping, targeting, maybe a little geophysics, et cetera, really focusing on vectoring in on where the best drill targets would be. And I think that's paying off. A prime example of that is the company that's been my top pick in Gold Newsletter really for about a year now, and that's Prospector Metals, a company that could have drilled last season on its project in the ML project in the Yukon, certainly could have raised the money to do so, but instead decided to do the proper groundwork and really understand the project before they started to drill. And that's really paid off for them, as we saw with the big news this week of the discovery hole on their test zone. That zone, if they would have drilled last year, would not have been drilled. But because they did the proper groundwork, they were able to find it, discover it, and drop a few holes into it this season. Next year, it's going to be drilled like a pincushion, of course, because they'll have plenty of money to do that. But, I do think that we're getting great results across the board. A lot of companies, a lot of new discoveries, a lot of better discoveries within discoveries happening because companies were forced to do that boring work while they didn't have the money to turn the drills.
Yeah, Brian, I think that's such a solid point because they did the lean and mean years of the mapping and channel sampling and all the targeting work. So by the time they finally now have raised money in a better sentiment market and they can finally pop some holes into these, they've had all this time to really debate internally, fine tune their targeting list and get the batting order right. So we're seeing some of the great results coming out of the gates here. Are you worried at all that we'll start seeing a little bit sloppier work now, though, because now after we'll get some initial passes on a lot of these projects, they're going to be cashed up more than ever. They're going to be firing off the holes, and that's where things get a little sloppier. Or do you think you'll start seeing some of these companies just separate from others because they've had so long to think about this? Now that they're cashed up, they can really rip.
Yeah, as always, it'll be a combination, and again, human nature will out eventually. So there will be some sloppy drilling. There will be some wasteful spending on drilling and other efforts because the money is flowing so freely right now. But as well, I think we'll see projects advance much more quickly. It would, it'd be a great business to be in drilling next year. And I hope that the drill companies are getting their capacity up because it's going to be another one of those boom years where it's going to be really tough to get a drill. And there's going to be a lot of companies that are going to be running multiple drills on their programs. And in effect, taking 3-4 years of work that we would have seen over the past and trying to get it done in one drill season, especially in the northern latitudes.
Brian, curious your thoughts when, look, we've seen a lot of these stocks, even the explorers, run up share price wise as they were financing. We are going to have a lot of shares coming free trading in the next, really starting in the next month or so, running to the end of this year. At least a lot of these recent financings have been without a warrant, but a lot of the financings a few months ago did at least have a half warrant because we've seen these stocks run up so much and because I think we're all expecting some delays at the assay labs. What's your strategy pre-assay results when you're already sitting on a pretty decent win, but do you take that risk waiting for the assays to come out? Because they can pop the stock much higher, but we can also see the stock pull back as more shares come out.
Yeah, it is, as with anything, it depends on a case by case basis. But if you have rich profits before that those shares come out, and or even if you have assays coming up, if you can reduce your risk and take your risk off the table and ride essentially for free, that's a very attractive thing in any market, but especially when we have a market like this that can allow you to do that and keep the majority of your stake to ride. We're seeing a lot of financings being done right now. And one of the things I've noticed is that there are some groups out there that are writing checks right and left without mentioning any names, but their essential business model is to clip the warrant. And so they are out there very aggressively writing checks, and they are the first ones to sell immediately upon the shares coming free trading, and then writing for essentially having that free option in the warrant. So yeah, the game is afoot once again, and I think it's important for investors to keep an eye on when paper is coming free, but also look at who the investors are in some of these deals and what the structure of those financings were. Very important to know who you're investing with.
Well, Brian, one other way that companies have been raising capital is with strategic stakeholdings from larger producers. And so I'm thinking in particular about Centerra Gold. They've gone out and taken stakes in about 8 or 9 different companies just over the last year, but a lot of it just over the last 6 months. And they're putting in a lot of capital to exploration companies in a way that it honestly is refreshing. It'd be nice to see more of the producers investing in exploration like they have been. Do you think this is a good route for companies to go? Are you excited to see producers investing in exploration?
Yeah, I think it's great. And frankly, I think it's to the advantage of the juniors more so than the advantage of the majors, because the majors they're not investing in a project level necessarily. So they aren't locked into that project. And sure, they have an upper hand to whatever degree that is, in getting that project because they already have, say, a 9.9% equity position in the company, but that doesn't guarantee them the project either. From the junior company standpoint as well, they get the expertise of the major investor. They get some very capable, experienced, high-priced geological teams essentially for free, better than free because they've got the money from the major as well. So it is really a great advantage, I think, this new or this old model that's come back into fashion for the relationship between the juniors and the seniors. From the senior standpoint, too, I guess it relieves them of some exploration obligations, and they can have a stake on an equity basis in these discoveries regardless. And it probably represents a bit less risk for those companies from that in that regard. So yeah, it is interesting, but I do believe it's great for the juniors because of all the advantages they get, and money especially.
So, Brien, any certain jurisdictions, areas that you're excited about that you could see as either growing, maybe not getting the attention, or quite frankly, is getting the attention, but you think there's a lot of good work going on? Generally, jurisdiction-wise, anywhere you like right now for people drilling.
I do look at companies on an individual basis, but I do like the Yukon now. I think Prospector has opened up an entirely new geological model for that area of the actual intrusions rather than the disseminated resources resulting from the intrusions. I'm looking at one other company up there, actually two other companies that have structurally controlled and/or intrusive targets in the Yukon. So I like that. Obviously, a lot of the typical areas like Nevada and the like, in Canada in general, I like. You don't, it's a big world, but you don't have to take on country risk in this kind of a market like you may have in the past. And a project that has some country risk to it has to be that much better than what you can find in safer jurisdictions. So I do look at each company again individually, but I would say the Yukon is particularly interesting to me right now.
All right, Brien, thanks for your insight on, I guess, mostly these exploration plays. There's going to be so much news coming out, and as we're seeing, the market is rewarding good drill holes. Just look at that Prospector Metals chart over the last couple days. Wild how much that thing moved, but hey, that was a very impressive drill hole, over 400 gram meters in that hole. So look, it's one of those things, carrying the risk into assay results. It sometimes makes sense when the results are that good, but also riding your position for free. I completely understand that strategy as well. Brien, always great having you on the show. Again, Brien Lundin, editor of the Gold Newsletter and our host down at the New Orleans Investment Conference, November 2nd to 5th. Have a great rest of your week, Brien.
Great. Thanks, guys.